Welcome to ET Money Ask the Expert session. Today we are joined by Mr. Arun Sundaresan, Head of Product Management, Nippon India Mutual Fund. The recent COVID-19 fuel market correction has brought back focus on asset allocation. And while dividing your investments across asset classes like equity and debt does reduce your overall portfolio risk due to diversification, your portfolio is not truly diversified. That's because your returns depend on the market performance of one country. That's where international funds come into picture. But what are these funds and how do they help you have a truly diversified portfolio? Let's ask Arun. Arun, thank you for taking out time and speaking to us.
Thank you very much for having me in the show. Looking forward.
Sure. Let's start from the basic then, Arun. What are international funds and how are they different from other categories of funds available to investors in India today?
Yeah, so these are, as the name itself suggests, these are actually funds where you can invest in Indian rupees. Domestic investors can also invest in Indian rupees, and it eventually gets deployed in international markets. Depending on the theme or depending on the objective of the scheme, it could be US, it could be Japan, China, it could be equity, it could be very theme-based like agriculture, energy, etc. But it does get deployed into international markets. So that's what these funds are.
Okay. So you mentioned, there are different types of international fund. You mentioned theme and countries. Can you walk us through what are different kinds available to investors today when it comes to international funds?
Yeah, so technically speaking, in terms of the types of funds, you have, funds which directly invest into securities like, stocks of US or, China, etc. So that's just one kind of fund. You also have fund of funds. You invest into a fund here, which feeds into another fund, which could be an international fund. That's another type. You also have ETFs, exchange traded funds, which invest into international markets. But these are just the technical aspects about, but regardless of what structure it is, taxation is going to be like debt because these are international funds. This is less of, the differentiation in terms of the types of funds. What is more important is where do they invest? Do they invest into a developed market? Do they invest into emerging markets? Is it theme-based? Like, is it, agriculture or mining or, any specific theme? So that kind of differentiate these funds. And, based on that, the risk return can be very, very significantly different. So obviously a fund investing into US cannot be compared with a ASEAN fund, with an energy fund or agri-commodity fund. So you have a whole gamut of such funds, so to say.
Okay. So as you mentioned, it's a mix of, where which countries it invests in, or is there a specific theme that that funds follow? Is that correct?
That's right. Absolutely correct.
Okay, sure. So you mentioned, Arun, about the risk reward. Let's talk about the reward first, or the benefits. What are the benefits as an investor gets when he invests in international funds?
Rajat, it's a very important question. So let me take some time and explain that. So basically, there are three benefits very, very clearly. First and foremost is that you're getting to invest into a different market, and that market can behave very differently from your local markets. So all of us have the local bias. We tend to understand, we think that we understand the domestic markets very well. Probably sometimes you could be completely ignoring international opportunities. So I'll give you an example, like last 1 year. So today, after the COVID environment, especially today, Indian market returns are down. Last 1 year, it's down by anywhere between 10 to 15%, whereas markets like US and Japan are actually up. They are, anywhere between 5 to 10% in the positive territory. So the difference between India and those market returns are almost 20%. And if you thought, this was an exceptional year because, there was a pandemic and therefore this kind of a movement has happened, this has happened quite often even in the past. For example, last year, 2019 calendar year, our markets were flat. Our returns were actually flat. US markets actually gave upward of 20% return. So this happens quite frequently. We call this, how the markets are correlated. Even though the underlying assets in this case are equity, you tend to believe that all equities behave similarly, but quite often the returns tend to be very, very different. And this exactly what brings to you the diversification benefit, right? So this is point number one. Second is you also get benefit of oftentimes the tailwinds from currency movements. Last year is a good case in point again. For example, while the difference in market return itself has been 20%, currency US dollar has appreciated vis-a-vis the INR by close to about 10%. So that also adds to your return. So essentially, you're investing into, let's say in this case, US stocks in US dollar. So therefore, you get the benefit of both the stock movement as well as the currency. And currency again, for example, a US dollar typically not just during this year, on an average tends to appreciate by 2.5%. Given that's a developed and in a hard currency vis-a-vis a developing market like us, where there is an interest rate differential. So that also acts as a tailwind. And the last point, again, which is very, very important, is that you get to participate, you get to invest into very, very unique and interesting ideas. Like, for example, US markets, the top 20% of the market consists of, the FANG stocks or the likes of Amazon, Facebook, Microsoft, Google, the Alphabet, which is their parent. So all kinds of these companies you get to invest in. You may not have an equivalent of those kind of companies in India. So you get to participate into companies which are very different, use cutting edge technology, and most of these stocks. In fact, even during the lockdown, I'm sure all of us would have realized any of these, whether it is a Netflix, whether it's a Facebook, Amazon. Amazon, for example, last 1 year has gone up by nearly 30%. Microsoft has gone up by nearly 20%. So you get to participate into those kind of stocks as well. MasterCard, Visa, large format retails. You don't have those kind of companies in the domestic market. So those are the three major advantages of investing into international funds.
Okay, sure. So you mentioned, Arun, about the currency fluctuations. Sort of leads us to the next question about the risk these funds carry. Can the currency fluctuations go the other way around and affect your returns? And what are the risks these funds carry apart from the currency fluctuations that they bring?
Yeah, so fair point. So just like how I gave you the good side of investing into international funds, that there could be times when those funds do very well vis-a-vis our domestic funds. There can also be times where the emerging markets, countries like India, markets like Indian markets do very well, at least relatively when compared to international markets. Case in point, for example, 2017, 2014, when we had a runaway kind of a markets, where our markets went up by nearly 35%, 40%. The developed markets, on the other hand, relatively underperformed. They may have given 15%, 20% kind of returns, which when compared to Indian markets are fairly subdued. In addition, whenever stock markets tend to do well, currency also tends to do very well. So you would have a double whammy. So on one side, your domestic market returns have been very good relative to the international markets. Currency also is appreciated. So net your return could look fairly subdued in those kind of years. So that's one thing that we need to keep in mind. Obviously, you may not have so much understanding about international market, be it developed or any kind of markets. To that extent, you're in a kind of a blind zone. So you will have to be a little careful. So you will have to keep those things in mind. But having said that, I would tend to presume that, especially when it comes to developed markets like US. See, for even for Indian markets to do well, largely a market like US should do well. So there can be a lot of times when US market does well, India also gets benefited. You still get benefited. Sometimes probably Indian markets run up significantly. Maybe the US markets might underperform a bit, but it should not hurt much. So from that sense, I think the rewards far more justified than the risk is my assessment of the overall international funds.
Sure. Arun, we've been talking about over the last 10, 15 minutes, and there's a lot of conversation around developed markets and US markets and the kind of stocks that it allows you to invest in. So would you say, with all the gamut of international funds available to an investor today, what kind of funds he should go for? And is it only that the US specific funds is what a person should be looking at? Or he could look at a more broader or a theme-based international fund that's available in the market also?
Yeah. So Rajat, the size of all international funds put together is less than 9,000 crores. We're talking about an industry which is close to about, let's say, 25 lakh crore. Equity funds itself is upward of 10 lakh crore. So essentially, less than 1% is what has gone into, even when you consider equity. So it's very, very underappreciated, first of all. Now, obviously, there is a very strong case for investors to look at, international, which we just talked about, right? Several benefits, and empirical data shows that there are a lot of times when these funds are done very well. But in my view, a good starting point for investors would actually be to look at developed markets. There are reasons why I'm saying this. Obviously, that's where you get the benefit of diversification. India being a developing market, and let's say it tends to get benefited during times where risk appetite is high, optimism is very good. That's when India kind of markets do well. On the other hand, if you're looking to diversify through international funds, it makes a lot of sense to be in developed markets. Like it could be US, it could be Japan, best probably Europe. Europe obviously is very fragmented. You have UK and a whole lot of confusions going on. So that is why I would presume that a good starting point could be a developed market, and particularly US focused funds. On the other hand, if you were to go to a Brazil or ASEAN, or Brazil, for example, this year is down by almost 30-35%. Probably similar or much worse than Indian market. So you're not going to get the advantages, the benefits of diversification if you go into a developing market again, or for that matter, if you're going into a theme, you'll have to be very, very clear, and you'll have to be extremely well informed. For example, if you're going for a agri commodity or a energy kind of an international fund, you need to be quite savvy. So I would recommend that for nuanced or advanced investors who have a fair bit of understanding. For beginners, for the general public, I think it will make a lot of sense to start with at least to look at developed markets.
Okay, sure. Okay, so we talked about where investors should be investing. Now let's talk about how much should be allocated to these funds. How much would you say the investor should allocate to international funds? And how should this allocation be seen as part of the broader asset allocation of your portfolio?
Yeah. So in my view, I think I did tell you that the current investments, as in if you were to look at these AUMs in international fund, is very, very low. It's underappreciated in the sense that given all these benefits. So definitely there is a strong case for investors to make reasonable allocation. In my view, the numbers can vary, probably anywhere between 10-15% is something that I would recommend to be the minimum allocation to these kind of funds. I think that will make a good starting point. For certain types of investor, it can even be higher because ultimately, as I said, these are equity markets, and for equities to do well, developed market like US anyway has to do well. So to that extent, you will have some similarity. On the other hand, when markets don't do well, there is a crisis and others, these kind of markets tend to do even better. Like, the last year, the case in point, currency tends to, kind of add to your tailwind. So given all of these advantages, I would advocate a reasonable allocation, if not 10-15%, somewhere around that is what, investors should look at.
All right, so with this, we come to an end of our video. Thank you, Arun.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.